In this video we will talk about different and simple formulas that will help you be prepared financially for emergency situations. Believe me, these formulas are very simple to remember and calculate. Emergency fund ratio. An emergency fund is the cash you keep on hand to pay for unexpected expenses, such as a job loss, a large medical bill, or a roof repair. This fund acts as a safety net so you don't have to go into debt. The formula for emergency fund ratio is very simple. Just include your monthly expenses like groceries, mortgage payment, and rent and multiply all of this with 6. Which basically means just 6 times the amount of cash you spend every month. Liquid net worth ratio. This formula is essentially an extension of your emergency fund. If you were to need funds as a result of an unplanned event or emergency, this metric looks at how many months of expenses would be covered by your liquid assets funds that can be easily and quickly be converted into cash. Just divide all your liquid assets, which will be mostly money, by your monthly expenses to get the ratio. Try maintain ratio between 3 and 6 months. Personal cash flow ratio. Knowing how much cash flow you have is useful because it tells you exactly how much money you have available to pay down debt or save/invest for your future. Formula is, monthly, after tax, income minus monthly expenses equals personal cash flow ratio. Housing to income ratio. This ratio is vital to helping you understand how much you can afford to spend on your home, whether you buy or rent. Formula is monthly housing costs divided by gross monthly income is equal to housing ratio. Debt to income ratio. The debt to income ratio is often used to determine a company's ability to pay its debts. It works for individuals as well. It tells you what percentage of your income is being used to repay debts. Formula is monthly debt payments divided by monthly gross income is equal to debt to income ratio. Example can be monthly $2,500 divided by $3,000 is equal to 83.33%, which is certainly bad. Try to keep at most 36%. Net worth ratio. Personal net worth is a measurement of an individual's total wealth. Your net worth ratio gives a little bit broader perspective than your debt to income ratio because it takes your total assets into account. It is calculated as the total value of all your assets minus the total value of all your liabilities. Savings ratio. Your savings rate is expressed as what % of your gross income you are putting away for the future, including retirement and other shorter-term goals. To calculate this, you'll want to add up your annual savings in any retirement accounts, including employer-sponsored retirement plans such as 401(k)s, traditional and Roth IRAs. Compare that savings to your annual gross income. Generally speaking, you want to aim for a saving rate of 10 to 20%. These are the ratios we talked about, extremely simple and which allows you to help make important financial decisions.